I've been quite shocked by what I've seen happening to buy-to-let mortgage rates in the buy-to-let mortgage market, and you might want to have a look at this. I've got a few buy-to-let mortgages expiring at the end of this month, literally expiring. I've had them on 20-year terms and the terms are coming to an end. And I had the choice really of being able to refinance with another lender or sell the properties or stick with my current lender and renew the mortgages. And I decided to go for the latter. I'm going to stick with my current lender and renew the mortgages, and they'll offer me a 10-year term semi-automatically, and I can choose the mortgage product I want to take. And this is when I became aware of what I can see as a potential massive problem in the buy-to-let mortgage market if things carry on the way that they are. Because the one thing which I've seen in doing my research and deciding what to do is that interest rates are now beyond anything I've seen for about 20-25 years. And if you're about to buy a buy-to-let property, or if you've already owned buy-to-let properties and you're just about to come off a fixed rate and you need to refinance, either with a new lender or with a different lender, you may want to watch this because you'll need to know this. But of course, this is not financial advice. I'm just somebody on the internet. I'm not a mortgage broker. I don't know anything about mortgages other than the fact that I have many mortgages and I pay them every month. But I'm certainly not an expert in buy-to-let finance. So please do take your own advice and come to your own conclusions. That said, I do think that there's a potential problem for a lot of people coming down the line. Let me explain why. Well, not long ago, this very tantalising article appeared on the BBC, which reported on the Bank of England's own findings that many hundreds of thousands, millions in fact, millions of mortgages are coming to the end of their fixed rate periods, both in the owner-occupier residential sector and in the buy-to-let investment sector. Now, unfortunately, I haven't got the split of the figures, but the Bank of England reported, and the BBC picked up on this, the Bank of England reported that 4.4 million mortgages are expected to see payments rise by 2027, including £500 per month hikes for around 420,000 households. It later goes on to say that by 2027, about 2.7 million homeowners will refinance onto a mortgage rate of over 3% for the first time. Now, I don't know whether that 2.7 million homeowners means that the balance of the 4.4 million is all buy-to-let mortgages. We can't say that. But the point is, without knowing the actual figures, by the laws of probability, a lot of buy-to-let borrowers are going to have to refinance because they're coming off fixed rates, or that, like me, you may be coming to the end of their term over the next few years. So I think this is really, really pertinent. So I have been doing quite a lot of research into what rates are available if you do need to refinance, or if you're coming to the end of a term like me and you need to sort out a new mortgage. Just to be clear, I have researched the main 5 buy-to-let lenders, the main 5 as I see them anyway. And over the next few weeks I'll bring you updates on all of them and all of the products that they're currently offering. But today I'm going to pick on Paragon because they are my main lender and they are the lender who I am refinancing with. And to be fair to all the lenders, I've done a sort of a like-for-like comparison of what they're currently offering on a purchase mortgage. Now, obviously I'm kind of doing a refinance and I could have looked at the refinance figures, but they're all very similar. And because I guess most buy-to-let investors nowadays are buying into a limited company, I started off looking for mortgages for limited companies. But in Paragon's case, on the website at least, it was very hard to see that there's any sort of differentiation. It seems to be the same rate. Now, as I said at the very beginning, this is not financial advice. This is just my interpretation from having a quick look through on their website. I might be completely wrong. A mortgage broker may well leave a comment below saying, oh no, that's not right, which is fine. So I looked at the 2-year and the 5-year fixed and a standard variable rate, and this is what I found. For a 2-year fixed at the moment you can get a rate of 4.69%. Sounds pretty good. That's on a property with a loan to value up to 75%. Minimum valuation for Paragon is $75,000 per property. which you might think, if you're living in London, well, that's a crazy low figure. Actually, up in the northeast, which is where I invest, it's still possible to find a lot of properties are under 75,000. So the fact that they have a 75,000 minimum valuation is actually something of an annoyance, but there we go. And the standard variable rate, intriguingly, has a 2-year discounted period at 5.37. Here's the thing that shocked me though. At the end of each of these terms, whether you take out a 2-year, the 5-year, or on the standard variable rate, you will revert back to, at the end of your fixed term, to the variable rate. Nothing surprising there. But perhaps what is surprising is that the variable rate at the moment is at a whopping 9.1%. The initial periods, of course, don't look too bad. My worry is what's going to happen when you come off the fixed rate and you end up paying 9.1%. I haven't seen rates like that for 25 years. When I first started 25 years ago, the standard buy-to-let rate was around about 8%. The thing which really worries me about this is how many people have been buying properties which have a yield sufficient to cover a mortgage payable at 9.1%, and I would suspect very, very few of us. So this could be a shock for a lot of people. Now, as I say, going back to the data, it's very hard to work out how many buy-to-let mortgages are coming to the end of their fixed rate periods. But I do wonder whether the lenders are going to have a look at this. Not just Paragon, I'm going to show you over the next few weeks that there seems to be a sort of a collective madness amongst the lenders. You know, I often go by the principle, just because you can doesn't mean you should, and just because the lenders can put their rates up, should they? What's going to happen to all of their existing borrowers? Are they really looking to wreck their loan books? Are they going to step in and do something special for their existing customers? Are they just trying to persuade us to refinance elsewhere, in which case it seems like a very strange business model. Why would you want to take on a borrower and get them tied into a mortgage only to then encourage them to move on after their 2-year or 5-year fixed rate period comes to an end? Just do not understand that. But as I say, there seems to be a collective madness because they all seem to be doing it, and I would suspect that a rate of 9.1% is not going to be sustainable for many, many people, which means that the lenders are just going to wreck their loan books and presumably have to make the decision, are we going to repossess en masse? Are we going to go and take over the management of all these properties? What are we going to do? So interesting times, perhaps too interesting, not a problem we really want to have. Now, this isn't intended to be a doom post, and so the sort of ray of sunshine here is that there is the potential for the Bank of England to bring base rate down far more quickly over the next 12 months than the media have been telling us. To be fair to the media, they've only been passing on what the Bank of England have said. We've already seen lenders at the beginning of this year already beginning to cut mortgage rates. Not by a great deal, but they've been cutting rates rather than putting rates up, which is a hopeful sign. So maybe by the time you get to the end of the 2-year or the 5-year fixed rate period, rates won't be at 9.1%. Maybe they'll be down at 6% or 5%. Who knows? We can only hope, can't we? But as things stand at the moment, I would be thinking to myself, and I am thinking to myself because I've got to refinance at the end of the month, I need to be in a position in 2 or 5 years' time, depending upon which of these products I take, I've got to be in a position to be able to sustain a 9.1% mortgage rate. That's the challenge, isn't it? But at least there's a little bit of grace. There's a couple of years, 2 years, 5 years, whatever, where we have time to actually plan for this and to make sure that everything will work out okay. Anyway, this is just what I found when I was sort of looking at mortgage rates. Thought it might be of interest to you. As I say, I'm not an expert and I can't give financial advice, but I do know a very, very good mortgage broker who is able to give financial advice and who is qualified to give you advice about mortgages. So if you are coming up to the end of a fixed rate period, or if you're coming up to the end of a term on the mortgage and you need to remortgage, or if you're just thinking about going out and buying a property and you want to get a mortgage and you want to get the very best terms for you, then I'll be very happy to put you in touch with my very good mortgage broker. All you need to do is to email me, thepropertyteacher@gmail.com, thepropertyteacher@gmail.com, and I'll be delighted to make the introduction.